Hi, this is Ramiz Ali back with the Smart Money podcast. Let's start with the news. First, Canada. The National Bank of Canada became the first of the country's top five banks to support a Canadian dollar stablecoin. This isn't a startup experiment for a fringe pilot. This is one of Canada's major banks saying, we're in. That's significant because banks in conservative markets like Canada usually move cautiously. Their endorsements send a signal that stablecoins are crossing the line from risky innovation to legitimate infrastructure. Second, Stripe. At its Singapore event, Stripe announced expanded support for stablecoin payments across Asia. That's important because Stripe is the plumbing of the internet economy. Millions of businesses rely on it to accept payments online. If Stripe is normalizing stablecoins as a payment method, we're no longer talking about niche adoption. We're talking about the rails of global commerce starting to integrate programmable money. And third, the United States. In Washington, lawmakers are debating the Genius Act. The controversy centers on whether banks can issue stablecoins with different reserve rules than fintech issuers like Circle or Tether. Banks argue they should be trusted more. Fintechs argue that creates an uneven playing field. And regulators worry about systematic risk either way. The fact that this is even on the legislative agenda shows how central stablecoins have become to the future of money. These three developments, a national bank adopting stablecoins, a fintech giant expanding them, and regulators debating them, together tell us one thing. Stablecoins are no longer optional, they're becoming a core part of the financial system. Now, before we go further, let's step back and define what we're talking about. What is a stablecoin? At the simplest level, a stablecoin is a digital token on a blockchain that is pegged to a stable asset, usually a fiat currency like the US dollar. The most common form is fiat backed stablecoins, where the issuer holds real reserves. Dollars in a bank account, short term treasuries to back every token. Examples are USDC from Circle and USDT from Tether. There are other types too. Algorithmic stablecoins try to maintain their peg using supply and demand mechanics, though many have failed spectacularly. Tokenized deposits are another form where banks issue tokens that represent deposits held in regulated accounts. The key thing about stablecoins is not just stability, it's programmability. Once you put dollars on a blockchain, they can move instantly, globally, and automatically. You can embed logic into them. They can interact with smart contracts. They become money with code. In my book, Programmable Finance, I describe this as the shift from money being a static ledger entry to money being an active participant in the system. Instead of just recording transactions, money now executes them. Stablecoins are the first large scale example of programmable money in action. Let's figure out why banks care. Why would Canada's National Bank or JP Morgan or SBI in Japan invest in stablecoins? The answer is efficiency and new revenue. Cross border payments are the clearest example. Today, sending money internationally often requires SWIFT, correspondent banks, multiple ledgers, and several days of delay. With stablecoins, you can settle instantly, 24/7, with far fewer intermediaries. That's cheaper for banks and better for customers. Lending is another area. Tokenized deposits and programmable stablecoins can create new lending models. Loans can automatically adjust interest rates when certain conditions are met. Collateral can be margin called instantly when thresholds are breached. That reduces risk and overhead. Treasury management for corporates is another use case. Imagine a treasury department holding stablecoins that actually sweep into higher yield products overnight, or that settle supply invoices the moment conditions are met. That's programmable finance, and it's only possible when money itself is digital and programmable. Tom Lee from Fundstrat put it well. He said that banks that embrace tokenization could be rerated like tech growth stocks. Why? Because tokenization gives banks scalability. They can do more business with less cost. They can launch new products faster. They start to look like platforms, not utilities, and the markets reward platforms with higher valuations. For decades, banks have traded at low multiples because they were seen as slow, heavy, and bound by regulations. Tech firms traded high because they scale fast with low marginal cost. Stablecoins and tokenization could allow banks to shift categories from financial utilities to programmable platforms. That's why banks care. Let's talk about the policy battle brewing. Of course, where money goes, regulations follow. And that brings us to the policy battle around stablecoins. In the United States, the debate over the Genius Act is exposing the fault lines. The bill includes provisions that could let banks issue stablecoins under different reserve requirements than fintech issuers. On the other hand, that makes sense. Banks are already heavily regulated with deposit insurance and capital rules. On the other hand, it risks creating an uneven playing field. Fintech issuers like Circle argue that if banks get special treatment, innovation would be stifled. Regulators worry about systematic risk. What happens if a bank issues billions in stablecoins that are not fully backed and they face a run? Globally, regulators are taking a different approach. Europe is implementing MiCA, which sets rules for stablecoin issuance. Japan has legalized stablecoins but restricted issuance to licensed banks and trust companies. The Middle East is experimenting with central bank based stablecoins for cross border trade. What's clear is that no jurisdiction can ignore this. Stablecoins are becoming too big to leave unregulated. The policy fight is really a battle over who controls the future of money, banks, fintechs, or governments. And in programmable finance, I argue that this tug of war is inevitable. Whenever money infrastructure changes, power shifts. We saw it with central banks taking control from private issuers in the 19th century. We're seeing it again now as programmable finance challenges traditional gatekeepers. Let's talk about some institutional use cases. Visa has already piloted stablecoin settlements with USDC. Instead of using traditional bank wires, they can settle merchant transactions on chain. That reduces reconciliation costs and speeds up payment. Trafigura, one of the world's largest commodity traders, has explored tokenized supply chain finance. Imagine a cargo of oil represented as a token with payments and financing attached. Stablecoins makes that possible because the payment leg can settle instantly alongside the asset leg. In Singapore, the Monetary Authority has run pilots with tokenized deposits and stablecoins for cross-border settlements. And now with Canada's National Bank, we have a major traditional bank aligning itself with a stablecoin project. That sends a message to corporates and investors that this isn't fringe anymore. The key here is programmability. Stablecoins are not just digital dollars, they're dollars that can carry instructions. Pay when goods arrive, release funds when compliance checks are complete, allocate treasury when rate changes. That's magic. And that's why I say programmable stablecoins are the foundation of programmable finance. Without programmable money, programmable finance is just theory. Stablecoins make it real. Let's cover the risk and challenges. First, regulatory uncertainty. Inconsistent rules across jurisdictions make adoption messy. Second, issuer risk. Do you trust Tether's reserves? Do you trust Circle's banking partners? Do you trust a bank tokenized deposit program? Stability depends on credibility. Third, technology risk. Which blockchain do you issue on? Ethereum, Solana, private permissioned chains? Interoperability is still a challenge. And finally, competition. Banks want to control stablecoins. Fintechs want to innovate with them. Governments are experimenting with central bank digital currencies. The competitive landscape is messy. These risks don't mean stablecoins will fail. They mean winners will be those who navigate regulation, build trust, and scale securely. Let's talk about where is this heading. In my view, stablecoins will become the dominant form of cross-border settlements in the next 5 years. They're simply too efficient to ignore. The big debate will be tokenized deposits versus public stablecoins. Banks will argue for tokenized deposits to keep control. Fintechs will push public stablecoins for openness. My view is both will coexist, with corporations using whichever offer the most efficiency. What matters most is programmability. Once money carries code, the possibilities multiply. AI agents moving funds, supply chain financing themselves, governments collecting tax automatically. We are entering an era where money is no longer static. It's active, it's programmable, and stablecoins are the first big step. In closing, this week showed us three things. Canada's National Bank signaled the stablecoins are entering mainstream banking. Stripe's expansion proved fintech is scaling stablecoin payments globally. And Washington's debate showed that regulators see stablecoins as too important to ignore. Together, these events confirm what I've been writing and speaking about. The future of money isn't just digital, it's programmable, and stablecoins are the bridge taking us there. If you want to dive deeper, check out my book, Programmable Finance, The Future of Money in a Tokenized World. And of course, subscribe to Start Money Stack so you don't miss future episodes where we unpack the shifts reshaping finance. Thanks for listening, and remember, the future of finance is programmable.